Good morning, everybody. This is Keith Harwood here for Yellow Tunnel and Tradespoon for the Morning Bell. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, and myself are not investment advisors and not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and or the team at Tradespoon or Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. So please keep that in mind as you evaluate anything that we discuss for your own personal investment or trading portfolio suitability. And with that, we've got I think a anticipatory market here. Fight, flight, or freeze response. Now, what I truly expect is a bit of a freeze with a minor fight flight kind of jockeying for position ahead of the Fed and ahead of big earnings this afternoon. We may see some individual names shifting around, names that had earnings last night and this morning, of course, are moving on their own. Outside of that, as stuff starts to leak out for what the Fed is going to potentially say, that may have an impact on the broad market. And then after the close, when we've got Meta, Microsoft earnings, Qualcomm earnings, Robinhood earnings. Tomorrow morning, we've got a couple of other decent size earnings, like Roblox, AbbVie, MasterCard. These are names that are going to potentially impact the market, especially the tech side. Meta, Microsoft, Qualcomm, Lam Research. Those are big for the tech side, of course. Tomorrow we have Apple and Amazon, but we're awaiting some of this news and starting to get closer and closer to that point. It's known that when that's going to happen. By 5 o'clock today, we should have some clarity Eastern time on all of this, a lot of this information, not all of it, I suppose. We'll still have some earnings tomorrow afternoon. We'll still have some non-farm payrolls on Friday. But getting through half of that information, we'll call it, in Fed and Microsoft and Meta earnings is a big hurdle to jump through. Now, if that's all neutral, great. Market, I think, starts to go into bull mode. If it's all bullish, even more so. And if it's all bearish, we may see that dip, and then we have to look for those support levels to determine where we can potentially stall out, and then await Apple and Amazon earnings. To me, again, I believe Microsoft is probably the most important of the tech earnings this cycle. A lot of times we focus on Apple. Microsoft has been on such a tear and been such a driving force behind the tech rally with their AI focus and everything else, while Apple has been a bit of a laggard recently. So the big driver right now seems to be more so than anything Microsoft, and then of course like stocks in the AI field like Palantir and semiconductors like Nvidia, but those aren't happening for earnings this week. So we focus on what we've got, and I think Microsoft's going to be a big one, and of course the Fed. So with all of that in mind, just trying to determine how and if I want to have positioning going into that sort of stuff. And if I don't want to have positioning going into it, that's okay. I can wait 24 hours and reevaluate the market in the morning, or I can wait 48 hours and reevaluate after all this news is out. That's a reasonable thought process in light of uncertainty. There's the alternative, of course, of just saying, look, certain trades aren't going to be subject to that, or certain trades are going to be potentially lucrative because of the fundamental input. Looking for those earnings plays, looking for those fundamental input plays. And that's what I want to focus on today, is focusing on those names that have that potential for something interesting, whether today, tomorrow, or Friday. As usual, that's a focus on probability of success versus return on capital. Now, the earnings plays are built on return on capital, not probability of success. We know that, right? We're looking for opportunities that have a potential for a low probability of success, but a big return on capital. So it's not necessarily a 50-50 coin flip even. It can be a 20% probability of success, but if it has a positive expected value, it can be a justifiable trade. Now, if one doesn't want to take that risk associated with a 20% probability of success, knowing that more often than not, I'm going to lose on this, but when I win 5, 6, 7 times what I would potentially lose, then so be it. That's not your trading style. That's okay. If one just looks for outright potential expected value, they are potentially very positive trades. On the other side, we're looking still at those credit spreads as the high probability of success type trade. The return on capital is mitigated by that. And there are setups for a few of those, but given the number of fundamental inputs, it's a little harder to justify just selling put credit spreads and saying all the fundamental news will not impact these particular stocks in a meaningful technical way. Support doesn't need to hold when there's a major economic shift being priced in. Now, the Fed's probably not going to do anything on rates. So that's easy, or should be easy. They surprise us in lower rates. Okay, it's a little more difficult, but it should be easy that the result will be no change in interest rates this time. But the question I think in investor and trader minds is, what do they say about future expectations? What do they say about potential concerns regarding the rate cut plan for the rest of the year? And that can have a meaningful impact on the market if people feel a little bit less certain about their projected path. You know, years ago, somebody told me the biggest thing with the Fed is that they have to effectively give confidence to the market about what they're going to do ahead of time and then do it. When they surprise the market, either in a way that seems like it should be bullish or seems like it should be bearish, it's almost always bearish, because now we don't have that certainty that what they're doing is what they've said they would do, you know, what the market was expecting them to do. When they surprise, creates more uncertainty, which naturally leads to risk reduction. And I think there's a lot of logic behind that. When the Fed is the referees of the NFL game. When people are talking about the referees instead of the game itself, it's a concern that they're not doing their job the right way. When the referees are doing it right, they are almost forgotten. Now, it's hard to forget the Fed, given that, you know, we've got so much conversation about, oh, we need to fire Powell. He's doing a terrible job from the political side of things, from Trump. So it's a little harder to just ignore the Fed when there's all of that noise in the background. But as long as they continue as expected and just do their work, then they can become a forgotten element, just doing their job the way that they're supposed to, and let the market and the economy move as a result. And they just react to what's happening. You know, you don't get upset when there's pass interference if it's pass interference, and you have to call it in the NFL. But when they don't call pass interference, i.e. they don't change interest rates, they don't do something reactive to what's going on in the market, that creates a bigger concern. And when they feel like their hands are tied, as we were concerned about a year ago with stagflation concerns, we had inflation and a weakening economy. So you can't lower interest rates because of inflation, but you can't raise interest rates to fight inflation because of a weakening economy. That doesn't seem to be the case right now, but if that ugly word starts rearing its head again, and we start talking stagflation now or 3 months from now or anytime in the future, that's another concern point, because then it feels like the Fed can't do anything to fix what's going on for the economy. Now, yeah, it doesn't seem like that's the case right now. So all in all, to me, that means the Fed should be fairly neutral, but there's an outlier shot that something that they do or say changes the market tone. All right. There's no trend change, of course. Now, the trend right now, even if you have a dip yesterday and even a dip today, isn't defined, in my view, in that 2-day period. Right now, we've got a lot of fundamental information coming in. It has to be digested, and then we can see the trend change, if one were to occur. If we go bullish today, that just resumes the bullish trend that's already in place, confirms the bullish trend in place. If we end up down today, 0.5% or even 1% or 1.5%, that could be a big red flag that we may be shifting to a bearish trend, but it's just as likely that it's a dip, and it gets resolved before the end of the week as the market digests and then says, okay, great, buying opportunity, as it has been. Dips have been buying opportunities. It's a magnitude of the dip that becomes the question. Now, of course, I don't call the April fall a dip at this point, but that dip turned into something worse. During March, there was a reaction period that could be taken advantage of to reduce positioning, or maybe look for some bearish hedges or some bearish positioning outright. Right now, I'm not a huge proponent of just being outright bearish. I think that there is a justification for reducing bullish risk and or hedging the bullish risk with some light bearish positioning. And with all that in mind, we got to keep an eye on everything that's going on and decide how to react. For the bull, potentially it really means allowing more time. And the VIX is somewhat low here at just under 16%. It can go lower. If we get bearish, it can go a lot higher. And so there is an offset. If the market goes down in a meaningful way and the VIX goes to 25 or 30, those long outright calls, the Vega, helps keep the value. Now the delta is going to hurt, but the Vega impact can help offset some of that loss. So a long outright call does again have some justification to me. For those looking anti-bearish, a put credit spread is always my preference because it doesn't leave undefined risk to the downside, and it helps ensure that if volatility spikes, I've got a hedge. So I've got a long option, which has long Vega, which offsets some of that. But more than anything, it caps my risk. It tells me exactly how much I can lose. If I think that Microsoft can't go below 480, then, even if I put in a put position buying a 470 put just to define my risk, at least I've capped my risk. Selling a 40 put and buying a 470 put gives me $1,000 max risk and the margin associated. Selling a cash secured 480 put costs a lot of money, 48 grand, right? I have to have the cash available to buy $48,000 worth of stock if I'm selling a naked put. So I can still trade in some of these high dollar names as long as I structure it correctly. Now, all that said, waiting till the end of the day to make trades can make some sense as well. The Fed announcement, we should start to see some information prior to the close. So getting some of that information in the last hour, I can start to react. We often get a head fake. So just because if at 3 o'clock the market starts to go down, it doesn't mean that we're actually going down. Get a little head fake down and then right back up, or we go up at 3 o'clock. I don't want to buy into that right after. I want to look for the opportunity coming within the half hour or hour of digestion after the fact. Earnings key. We got a lot coming up tonight and tomorrow morning, a few that are interesting that are actually a little bit less impactful to the market. For example, we got Roblox stock having earnings tomorrow morning. That's not going to move the market the same way that Microsoft or Meta will, or even Qualcomm or Lam Research. But it can be an interesting one to trade based upon some of the dynamics that occur with Roblox. So we got to take a look at those to see where names that may not have as much impact from non-farm payrolls or Apple and Amazon earnings tomorrow can still have a meaningful potential move. Sorry, 1 second here as we get right at the open. All right. So flexibility is key as always, especially in a time of a lot of fundamental information. Now the 10-year yield is doing what the 10-year yield just keeps doing. It tested 4.3, got to about 4.32, and then bounced back this morning. Currently 4.36, pinned to this 4.4 level. Maybe the Fed moves it off of this pin at 4.4, but really 4.4 has been our target. And every time we get to 4.3, there starts to be a little concern that maybe we're getting a break down to 4.2 or even the 4.1 level, and that could create a fundamental shift and thus an investment flow shift. And every time we get to 4.5, there starts to be that concern. Oh, is this finally the time that we break out, go to 4.6 or even higher? Then start talking about inflation again. It hasn't been happening. Non-farm payrolls today, on Friday, Fed today, maybe that breaks the range, but right now it's still a range-bound 10-year yield. And if we maintain this range through the rest of the week, I have that much increased confidence that the 10-year yield won't cause a dynamic shift in the market. I wanted to bring up the dollar because the dollar is rallying. It has been in a basically big bearish trend here, did some consolidation, a pretty traditional bottoming action. We will go through the falling period here in April, bounced up to the 50-day moving average and then fell again, a bounce and fade, a bounce and fade, a bounce and fade, didn't make the new low and now a higher high. So this is starting to show some real bullish chops for the dollar. For those looking at commodities-based trades such as gold, this can be a concern for you. If you've got dollar bullishness, that is usually bearish gold. So I start to wonder about gold as a trade here. And again, this may be one of those spots where I'm getting ahead of it if I try to sell gold right now. But maybe this afternoon, maybe tomorrow morning, even 50 bucks lower in gold prices, down closer to 3,300, it could be an interesting entry point if the dollar continues to show firmness. So I'm watching the dollar. I'm not necessarily jumping on anything yet, but dollar bullishness can have some bearish gold, precious metals type investment flow associated with it. So it's a separate thing from the stock market. It's a correlated thing to the stock market, but for me, the dollar and the impact on gold is potentially meaningful, and particularly when I look at dollar yen. So dollar yen is one of the stronger currency pairs in terms of correlation to gold, and when dollar yen is bullish, that is bearish gold, and we're testing resistance again here. So the 200-day moving average 149.5, the high from July 16th is 149.20. We're getting very close to that level right now. So again, if dollar yen in particular starts to run up here, get up to the 150, 151 range, that can be a very big bearish input on gold once again. All right, and it is correlated to the dollar, but it does move somewhat away from it. As you can see, this consolidation and the low was made in April rather than the low being made, just a few weeks or a month ago. MMFI, stocks above the 50-day moving average. Percentage of stocks above the 50-day moving average took a hit yesterday. And it dropped down to, and this is a 15-minute delay, so it dropped down to about 63%, near the lows of the recent range of this bull market. So with the small sell-off yesterday, we had more stocks falling below their 50-day moving average. That can be another little miniature yellow flag, but if we have a bull market today, we could jump right back to 75. So, it's something to keep an eye on, but not necessarily something to worry about. It helps mean to me that we're not in a true major overbought scenario where everything is being bought. Up around where we were in June 11th, when we hit close to 80, it can be a little bit of a concern that direction. Where we're at right now, there should be opportunity out there for those looking for bull cases, because the RSI is not 80 in every single stock. Now, it's up there in many stocks still, but it's not up there in every stock. Participation in the broad market buying brings this back up. Rotation away from overbought stocks into some undervalued stocks brings that back up. And then we start to see more bullish flow for the broad market instead of focused on some individual names. And then finally, Bitcoin for a risk on barometer. There it is. I don't want to do it against the tether. Bitcoin USD, stable. So risk on shows us above 120. Risk off shows us below 116, 117 range, 116.5. Sort of in this range that we've been stabilizing and showing real support. We'll call it 116.5. Below that, I start worrying about 112. But again, I think that this is going to be paired with a drop in Bitcoin. I expect to be paired with a drop in the US stock market. So S&P 500 and tech down seems to be more likely to be paired with Bitcoin down. So do I want to trade Bitcoin names today? Maybe not. Maybe some of the individual stocks that have been falling because Bitcoin's not been dynamic, so people are rotating out of them, could be an interesting R&R setup to the upside, but it is contingent upon Bitcoin rallying above 120. So if I start seeing risk on, I do want to have a quick look over to my Bitcoin related names, and that could be Marathon, that could be MSTR. Right now, greater focus for me would be like the MSTR and the Marathon setups, given the pullbacks that we've had here from 21 down to 17 and change for Marathon, and it is up a buck today. Riot has been a leader in that field, staying near the previous highs around 15. And Hut 8, just as a reminder, they announced a convertible note so they could go out and buy more crypto, and that hit the stock last week. Ultimately, this is now a little tougher to buy into given the convertible note and the overhead resistance. We may need a little bit more time before Hut 8 becomes truly dynamic. Marathon for me is one of the better avenues, but being up 6% already means maybe I go back to the big boy and go to MSTR. Now let's talk S&P 500 levels that we're worried about for today, tomorrow, Friday. This 626 level, 625 range, 627, right in here, down about 1.5 to 2%. That can be a firm support point, given that that was the previous resistance. Well, and it's also lined up with the 20-day moving average that we haven't really been able to breach meaningfully. We tested below it a little bit at the end of June, a month ago, but we really haven't been below the 20-day moving average since April. Traditionally, the 10-day moving average has been a good buying opportunity for a dip. Maybe a little bit more room now, down towards 627, 626 as a projected potential buy zone. 628 is okay for like today maybe, but for the end of the week, I'm looking 626, 627, or I could get even more conservative and go all the way down to 620. We got a lot of support levels below because we've been in a bull market. Resistance above is simple. It's yesterday's high. 638.67, $3 away, 0.5%. A move above could create some spike risk. We haven't seen aggressive selling of calls broadly, buy writing of positions, and that's part of why the VIX is still 16% instead of down around 13 or 14. Well, let's say 14. We did get down a little bit closer to that level, but over the last couple of days, we've seen some buyers of puts, people hedging in case we go into a bear market, and I think that's a little bit overplayed out. People buying those puts now, yeah, if we drop 1.5% this week because of fundamental inputs, then it was the right time. But with all of the support levels that are below the market, it seems unlikely that we shift from bull market into straight line down falling knife. Harder to see that, envision that, barring a real major surprise. And frankly, I think that real major surprise would have to come more from tariff side of things than from the Fed, non-farm payrolls, or earnings. So the tariff side of things seems like it's going according to plan or according to expectations. China is the one that we are still waiting on more than anything. Everything else seems to be moving forward in a productive manner. Maybe not a perfect deal for anybody, but that's the art of negotiation, right? If one person walks out of the room happy and one person walks out of the room upset, means that the happy person won at the negotiation, the sad person lost. But more often than not, both sides have a little bit of give that they have to put in there to get to a deal where nobody's truly happy, nobody's thrilled, but it's stuff that we can live with. And I just don't see the SQDEX necessarily showing that it needs to be bought down to the downside unless it's just for a protective put when selling a put credit spread. Now that also makes it a little more difficult to sell a put credit spread because the further out of the money puts are priced relatively high. Now the VIX dropping 2% or holding support and everything else and using that as an anti-bearish view, it can still work as long as I'm collecting the theta. But right now I'm not getting as much premium for my put credit spreads because of this elevated skew where people have been buying the out of the money put, which is what I need to buy when selling a put credit spread. So I also have to factor that into my viewpoint of, do I want to sell put credit spreads? It's a little harder to do so. I got a number of reasons why not to. Puts are expensive, so put credit spreads are a little bit cheaper. There's fundamental inputs that could cause a bigger shift in the market than what we've been seeing recently. The S&P, the realized volatility is significantly lower than the implied. It's about half of it, maybe even a little less. Market's just not been moving. So selling a put makes some sense from that perspective, but now we got the inputs and maybe we get the move now. So the timing of the put credit spread, may have been best suited for expirations yesterday and before. But now that we got the inputs, do I really want to sell a put credit spread? It's like selling a put credit spread the week before earnings in a stock, but not the week of earnings, because you never know if something on the earnings is going to cause a bigger shift than the normal realized move on earnings for that stock. We won't know until we see the announcements. When you go a little bit smaller, small caps continue to just consolidate here. My main support is just sitting down here at this 216, 217 range. It's a ways down. So given how far down the support is for IWM, relative to like the S&P, for example, you know, needing 3.5%, 3 to 3.5% to find my real support. You know, I don't necessarily have a huge desire to sell a put credit spread in IWM either. And then the resistance here, initially about 227 and ultimately up at the previous high of 231. Previous all-time high, 245. So we got resistance here at the 231 level and then up at 245. So we do have some hurdles to get through for IWM to get really bullish. And again, it's not just going to have to be powered by XLF, which has been positive as a sub section of IWM, doing better, but XLV. And we're just not seeing that money flow in XLV. UNH yesterday didn't help that. United Healthcare had poor earnings. It's just been a continual downward spiral for United Healthcare. Maybe they eventually get it figured out, but for now, it just continues to go down. While like, you know, another healthcare name, Johnson & Johnson, had bullish earnings, and that could be a somewhat of an offset, you know, a counter to it, showing some bullish behavior. But within XLV, it is a very stock picker's game, not a bullish trend, just trying to find a bottom and then seeing if money flow starts to go in a much more meaningful way that's just not there yet. Tech has been a nice bull run. Yesterday's high, 572. So again, about 0.75% away for a new all-time high for the breakout. Support for me looks like 557, down about 2%. Big support down at 542, down about 4%. So we've got some support levels again below this market. You know, you could say 566 has some support, but that's really tight. Going down towards 557, going down here towards 550, and then down towards the previous high, 540, call it. All right, so we've got a bunch of support levels in S&P and QQQ. We've got a chopping sideways market in IWM, and I think driven mostly by the fact that we just can't seem to fall in love with healthcare. Semiconductors are bullish on a relative basis. Yesterday's high was 297, today's high is 296. And when I go out a year, we are now fully here in the all-time highs. So I had to go out 2 years because we had to get to July of 24. The high was 279. So we broke through that just about 2-3 weeks ago, and now back into that what I call the blue sky breakout. No overhead resistance that is naturally obvious. And again, this is driven right now as much as anything by AMD outperforming. NVIDIA is still good because everybody loves NVIDIA. You know, when you talk semiconductors, the first one everybody comes up with is NVIDIA. And NVIDIA is still showing that bullish bias. Yesterday tried to get really bullish, faded back below the previous day's high. Monday's high was 177. We're back above it. If this can hold through the day, then the bull trend really, I think, solidifies here in NVIDIA and looks really solid. Apple and Microsoft earnings can matter. AI, you know, the end users of semiconductors really can matter. So if the end users are showing weak earnings, they may have less demand for it, and then that can create a problem for NVIDIA. And then the same sort of tune can be said for LRCX, being, you know, in the semiconductor space. If they have weak earnings, much like Texas Instruments had weak earnings, Texas Instruments fell, and that pulled down ON, for example. And ON bounced back because it wasn't their earnings, but they've got their earnings in a week. But I think it's important to know that when certain semiconductors fall, that can have an impact on other semiconductor names and other end user names. So if LRCX earnings are weak, that means to me that their end users are buying less. And that may give a predictive element to what the earnings are going to come for their end users. Let's run through some names here. Amazon's got earnings tomorrow, and an aggressive power trader. It was a listed bull stock. Now, again, just like what we saw yesterday when we were talking through STX and Microsoft, I'm not a proponent of using the technical and the money flow ahead of earnings as an indicator to go ahead and buy like an at the money call or sell a put credit spread. If anything, it just means to me I may want to lean towards a bullish earnings play, or I may want to avoid it. Now, in STX's case, they had the bearish earnings, dropped to 141. Up now 143. Support 141.71, and then that got breached this morning and then bounced off. You know, we had talked about it yesterday, a potential for like a put fly targeting 140 paired with a call fly targeting, what was it, 165. That's okay right now, 3.5, a buck, about $1.35 for the put fly now. It's not great, not bad. You know, it's in the window now, back above some of these like 144, 145 levels starts to tell me that people are willing to buy the dip. But you know, oftentimes it happens that way, and other times we just continue to drift down afterwards, like we saw in Texas Instruments. So it's in the right window. Not a home run by any means. We got a lot of week left for us. We've got 3 full trading days to navigate and digest and decide for STX whether there's going to be more selling or if it's going to be stagnation or bounce back fully and get back to 150. But the reason we do these earnings analyses is, you know, it's been about a 6% mover. Now it's dropping down to 5.5%. I was looking for it to be, you know, in that 140 range, so closer to 7-8% move. But we're close to it at least, and again within the window. But that may be a short-lived move to the window. Let's go back to Amazon. So I'll focus more on Amazon earnings plays tomorrow at the closing bell, but for those that can't make it for that and want to think about it a little bit more ahead of time, this is normally about a 7% move. Now, last earnings was an outlier. Nothing. 0.12% move. If I'm looking for a normal move here, I'm looking for 6.5, 7%. That's about 15 bucks. So for now, that would be 215 and 245 would be my general target range. 215, really close to this support level that's at 217.5. That's about a 6% move. That can make some sense. If I want to go symmetrical off of 217.5, now I'm looking at still 245, 14 bucks either way. In terms of the option open interest, it's very spread. A lot at 240 on the upside, a lot at 245, a lot at 250, a lot at 235. The calendars, 47 implied vol for next week. We expect this to drop down to about 26. A calendar can be an attractive play. It's a bit questionable, but it's not a bad play by any means. And I do think that if I'm going to go for a calendar, I go for the 250 line, big even number. And I know a lot of people like to go the 1 week calendar because it makes it cheaper. I tend to like to go a little longer, at least 2 weeks, generally up to 4 weeks. Give myself some time for the long side to play out. A 250 call in August 29th is 239. For this week, it's it's 57 cents. That's $1.80. That's not cheap. You know, usually when I'm looking for a 4 week calendar with a upside, I'm trying to get my long strike to be 1 to 2 times the price, or the long contract to be 1 to 2 times the price value of my short option. And in this case, it's closer to 4 times. So it's an okay trade, but it's not a home run. It's not a slam dunk. And if earnings come out on the bull side and we go to 245, it's a great trade. But if earnings come out neutral and we don't move and we do a repeat of May, it's going to be a loss. And if it's bearish, obviously it's a loss. So if I'm going to try to bring in a little bit of the money flow and say, well, the money flow should be right, given that they've been consistently buying, even at a much slower pace than Microsoft, I do want to think towards the bull case, but know that I've got some risk associated with it. And if I'm not comfortable with August 29th, I can go to August 22nd, cheapen it out a little bit here, $1.97 versus 57. It's still $1.40 for the calendar, but it does have some decent R&R to it if the market is bullish for Amazon earnings. The vega on these calls is 16 cents. The implied volatility should be dropping by about 9%, so about $1.40. That means that this is a 50-cent option if the stock doesn't move. So I need to have that offset by delta, which means I need $5, maybe $10 of rally to make money on a bullish call calendar in Amazon. If that's not high enough probability, then it's not a trade for me. And again, the double butterfly, I just don't see it this time for Amazon. Too much open interest spread out. The 6.5%, 7% move kind of makes some sense. 217.5, that's not the target spot. 245 seems like the rational idea, but the bigger number seems to be 240, and it's equal size roughly for 250. I mean, there's just too much spread to really pinpoint a earnings move here. It seems like, generally speaking, the market's not quite sure where it's going to be, but expects it to be between 215 and 250 after earnings. That's about all we've got here, and it's selling a iron condor like a 252.5, 255 doesn't give me enough money. Selling a 210, 207.5 put credit spread doesn't give me enough money. So I have to either do a calendar or a butterfly, and if I'm gonna have to do a trade, it's gonna be a calendar. And in my case, I don't have to do a trade. In your case, you don't have to do a trade. So, you know, I don't have to do anything here. Although, I mean, I can or should note here that the February high is 242.5. That is the all-time high here. So 242.5 is the all-time high. That could be some resistance. It could also just be a launching point if Amazon does join the party of new all-time highs in tech. BSX. It just had earnings, just had bullish earnings. So I like BSX from a technical perspective. It looks good for a potential 105 short put. For this week, it's only 28 cents. I don't want to sell that put credit spread for 11 cents. I like to sell my put credit spreads for $1 wide at 16, 18, 22, something in that range. And this is 11 cents. You know, to each their own on it. It's just, for me, it's got a high probability of success given the market pricing. But is it enough premium at a dime now to really want to put that trade on? And for me, probably not. Better for me in BSX to let this play out a little longer. And if we get above 107.5, 75 cents away, 0.75%, just a little under, in a stock that normally moves 1.25% per day, then I start looking for the bull play. It starts to set up more like a bull flag. It starts to look like taking out the upside highs. And then I go out to the September 110 calls or the 105 calls. Now, I like to have the 107.5 or something like that, where I get dollar strikes in the September 5th options. September 19th only has $5 increments, so I have to choose. The 105 call, higher probability, 110, more leverage. You know, thinking through which one I like better is really dictated by how quickly I think this rally can occur and how much it can occur. Can we go to 110? Sure. Can we go to 120? That seems like a big ask. So maybe that means the 105 is the better play, but I need to see that confirmation of some higher price action here, especially into the close, I suppose, to really give me some confidence in this. And then if we do start to see that price action closing around that 107.5, 108 level, instead of the 105.5 predicted close of today, the model should shift more towards a bullish vector instead of this neutral, slightly bearish. Finally, we got Walmart on our list. Now, Walmart is doing the same sort of chop that it's been doing. I mean, 100 is a big resistance point. We're $1.50 away. It can happen in a day. So for now, same idea as BSX. I think for this name, I can trade the range on a more aggressive basis, or I can wait for prices above 100. So short-term traders, you know, utilizing the range here, it's an expected dollar range today. We don't expect the breakout here. Naturally, I think that that's the right expectation, that we can pop towards 100 and then fade and then find support at previous lows and then potentially bounce until we do something else and break that wave of up and down and up and down and up and down. It's just not a trade for me personally, because there's not enough premium in selling a put credit spread, even selling a call credit spread for this week, 12 cents. It's not enough. You know, like I said, I like 16, 17, 18, 16. I start getting 15 to 16. I start getting more intrigued. Up around the 22 range, I start getting a lot more excited, and we're just not there yet. and it would require, a good 50 cents more rally, and really playing against that inflection point before I would have the premium that I want. But then I'm at the inflection point, and do I really want to play for the inflection point trade to not come to fruition when we're that close to it? I usually like to see a little cushion away from it, like prices around 98.5 with a fade, and then some premium that I can collect, and it's just not there yet. All right. Let me go to MRVL. MRVL, people are excited about their potential. There was a research report that they should be a benefactor of some Microsoft growth prospects and everything else. And right now they've got a nice bump up today. They got earnings in a month. So anything that I want to do, I've got a month. We're at the 200-day moving average. Support looks like, I'd honestly just use yesterday's level. So we're down at 76, maybe 77. For this week, it ain't happening. Maybe next week with this implied volatility pop, I can start to get excited about a 77, 76 or 77, 75 put credit spread. That gives me a really nice high probability of success and a decent return on capital. 77, 76 is 19 cents right now. I got to sweat through a week and a half, but they've got a bullish undertone to them that may or may not be wiped out now if Microsoft earnings are weak. So if this is driven by Microsoft impact on Marvell and Microsoft earnings come out weak, Marvell may now be tied to that earnings this afternoon. So there's a certain part of me that says, well, yeah, I'd love to sell the 77, 76 put credit spread today, but do I want to hold that through the Microsoft earnings? I'm a little hesitant. I'd like to see what happens if we get the earnings out first and this implied volatility remains elevated and Microsoft bullish earnings, yeah, straight to a put credit spread in MRVL and collect 20, 25, or maybe I end up collecting 21 cents now in the 77, 76. Maybe it becomes 18 cents. But as long as it's still within that range, I'm collecting enough premium to offset the risk. So, for me, my opinion is give Marvell one more day, see what Microsoft does, see what Marvell does in relation to Microsoft. And I think that naturally leads into the Microsoft earnings thought process here. Sitting at highs, normal earnings move has been about 3% on average, but recently we've been closer to 6 to 7%. So which one do we do? The long-term average of 3%, or do we do the recent 6, 7%? That's the big question, right? It's the $1 million question. I don't know, like STX had a couple of bigger moves there and then ended up going back towards the previous range, a little bit less than the last 3 quarters in terms of move size within the tech space. Texas Instruments was way bigger than the previous more volatile moves. So if I just play this out for maybe the 5% move, a little bit more than the market's expecting, that puts me looking at about a $25 move. So 485 on the low side and 537 on the upside. In terms of open interest, again, pretty spread once we get above the 530 level. Downside, not a big amount of concentration here. Normally I'd expect big concentration at 500, which is a 2.5% move. If I go out to August, we've got 525 as good open interest. 500 is not. 470 as big open interest. We go out to the other monthly serials, it's very spread again. It goes back to a similar setup to Amazon, frankly, where we just have a lot of potential price points that can create the magnet for the stock. And the implied volatility post earnings should drop towards about 16%. Now in this case, the implied volatility is more elevated. For the weekly option, it's 35%, 19% downside in implied volatility. The calendars, we're dropping about a third of the implied volatility post earnings from 24 to 16. So it's back to, for me, looking at, okay, well, do I want to do a call credit spread and a put credit spread? That's not honestly that bad right now in Microsoft. As long as I don't see a $30 move, 6%, or a little bit more than that, I can look for a 540. Here we go. Sorry. 540, 542 and a half put credit spread, 32 cents. And a 484, 77 and a half put credit spread for 22 cents. So it's about 50 cents, plus or minus a few pennies. So about a 25% return on max risk. So I need to have a 75% chance that we stay in that range, that we move less than 6% on earnings. That seems, I would think it's probably closer to like 80 to 85%, so a slight positive expected value. You know, to get the high probability of success, I have to get down to the point where I'm selling like a 470, 467 and a half put credit spread. And that's only 7 cents. That's not justified. I'd have to sell the 550, 552 and a half for 13 cents. It's only 20 cents for the iron condor. To me, that's not justified. But going a little bit tighter, going within the expected range and saying less than 6%, that may be about the best I can do in Microsoft. I would honestly expect that upside, we're not going to see 6, 7, 8%, given that we're already at highs. Bigger concern would be the downside could come into play, but I think the iron condor makes more sense in Microsoft. Same idea in Meta. So Meta is currently trading at $700. Normal earnings moves have been around 4%. We're pricing in 6%. It's skewed by this 20% move in February. And this is kind of a reminder of what can happen and why we use it as defined risk. But if the market's pricing in 6, normally prices in 7.5, and we've been normally getting closer to 4, I could look to sell a 650. Here we go, 650 put and a 750 call, and then pair that off into an iron condor. And it collects them a little bit. You know, I get 90 cents for the call credit spread, 750, 755. I get 75 cents for the put credit spread. So 75 cents for a $5 wide put credit spread. 90 cents for the call credit spread, it's $1.65. It's about 32%, 33% of the max value, which means I got to stay in that range only 67% of the time versus Microsoft, I was saying 75% of the time. So Meta actually has the better iron condor to me than Microsoft, and looks like a more attractive entry point. And it's betting on less than 7%. That seems like a high probability of success. We've had it twice in the last 2 years. And when we did it, we moved a lot. So I may have that full loss. So about 25% of the time, I'm taking the full loss. 75% of the time, I'm taking the full gain. And we're pricing in that I have to have it stay in that range only 67% of the time, not 75. Again, positive expected value. Yeah, let me take a look at Kroger for you, Tad, here. Kroger got hit down on Monday, finding support here at the previous lows. Finding support at the 100-day moving average, the 50-day moving average, playing around at a big support level here, kind of at the inflection point. Let's see here. They don't have earnings for a couple of months. So now this is just about how's the volatility levels. They're slightly elevated, but they're near the 6-month lows. What's been our traditional behavior here? When we get the run, we dip. It's a bounce and fade. Bounce and then broke the 100-day moving average and then ran up into earnings. Dip and bounce and fade. As long as this 69 level holds, I'm looking for a bounce back towards 71. 69, 68 put credit spread for a quarter seems decent. I need to bounce 75% of the time. Fail 25% of the time for that to be right. Do we fail more than 25% of the time at support here? That's the ultimate question, right? If I set my stop tight and say if we get down towards 68.5, that's my sign that it failed. The low on July 3rd was 68.62. So now I'm risking 1-to-1 on the reward. So if I can make that my trade, that we don't fail in the next 3 days with a price below 68.5, now I've got a coin flip. Because at 68.5, the put credit spread, or the put spread should be worth 50 cents. We're halfway between the 69 and the 67. It might be 52, 53 cents because of the skew. But I think that's the way to structure a Kroger trade at this point. Sell a put credit spread, manage the entry point, manage the monitoring of it. Or a stock trade. You know, buy here, stop at 68.5, target around 71.25. Get back to the 20-day moving average. You know, I'm not looking for a full appreciation back to 73.5. I'm looking for a bounce back of about half of the drop. So I got $2 of upside, 80 cents of downside for a stock trade. I've got kind of a 50-50 shot, or better than 50-50 shot. I think 75% shot of is about right for the bounce back. But as long as I stop out at 68.5, now I've got a positive expected value by selling the put credit spread. So, you know, 3 times the probability of success with equal risk to equal reward. And then the stock trade, about 2.5 times the reward if we hit the price target. And we may just consolidate here. In that case, then the put credit spread is the one that makes money. You know, that's the nice thing about the put credit spread. I don't have to go up. I just have to not go down. Bounce back, I have to go up in order to profit off of the stock trade. So those would be the 2 avenues I would look at this for Kroger, is buying the stock here. And as long as we stay above 68.5, I feel pretty good about it. If we breach 68.5, then I'm either looking bearish or just out of Kroger. All right. Yeah, let me run through a couple of other trades we got on our page just to make sure you guys are all watching with those. Caterpillar, yesterday was looking somewhat weak here, and we keep finding support of the 10-day moving average, so everything okay there for now. I'd like to see some upside. I think that that's going to be driven by economic indicators, that so i.e. Fed today and non-farm payrolls on Friday. CSX, still playing off of some of that UNP Norfolk Southern merger news. The options are getting hit in implied volatility. So 36.5s are down small here, maybe 20% because of the implied volatility hit. Should note that on Monday's close, the calls that we had were about twice the prices of what they are today, because the implied volatility came off so much once the UNP Norfolk Southern deal got announced, dropped from 29 to 22, almost an earnings-esque implied volatility hit based upon some merger calm down. Overall, still looks okay. ES holding strong here, bounced off. Utilities had a little bit of money flow yesterday. We'll be looking at a potential early exit there if we get back up towards the previous highs. Probably need to go to about 60. Probably actually need a breakout to get the early exit there. Otherwise, looking overall strong enough. Unlikely to get a $1.50 move today to get the early kick out. You know, that'd be 2+%. This is normally a 1.25%-ish mover, so we need a 2 standard deviation move. It's not the most liquid name, so maybe we get it. Maybe we get a little lucky. We do have earnings tomorrow after the close to note, but traditionally utility earnings are 1 to 2% movers, so it's not that much more than the normal daily move in these kind of stocks. Sometimes it's different. I mean, I think it was NEE that just had earnings. Yeah, they just moved the stock pretty wildly. So within the utility space, we had a 6% move. But NEE has a history of having some of those bigger moves. What else we got? We got Invesco, not doing much here, kind of slowing down here, but just hanging near the highs. There's not much concern for me there. Hopefully we get a little bit more money flow instead of just stability here, maybe on the back of Robinhood earnings or something like that. Would like to see a little bit more firmness there, but we'll see how that goes. For now, it's okay. And then NVIDIA, of course, looking the best of all today, but just back above yesterday's highs. So now about a break even in NVIDIA. So, I mean, kind of a general sense across the board average. We've got like NVIDIA around a break even, Invesco around a break even. ES is actually our big winner for the moment, and CSX down about 20%, and Caterpillar down about 10%, I think last I checked. If 10 to 15%. So net down small to start here. But you know, I think that's, you know, sort of somewhat natural with the money flow that came yesterday, where the morning was the highs, then we faded, and now we're just checking to see if any of these inputs drive new highs, which could be the global economic conditions, some of the earnings on tech, or if something spikes up with Berkshire Hathaway rumors for CSX. So we're in good shape, I think, there, just to hold for now. Well, we may put it in order to profit taking ES just in case something weird happens, because it's not the most liquid stock. You know, trades a couple million shares a day. So if somebody decides to buy 500,000 shares, that's going to move the stock. So just want to have an order out there in case of a liquidity gap. Back to a few more earnings here. We got Robinhood this afternoon, $105 stock, been on a tear. You know, normally a 10% move. My bias is to the upside. You know, back a year ago, I told you, gosh, you know, Robinhood's just not cutting it. And this is a stock that's going to zero. They figured something out. They got back in the game here. Upside's 10%, 115. Downside's 95. 115 has some good open interest, but it's still very spread. Downside 95. And right now we're building up a 97, 91 put spread today. Let's check and see if that was trading on the bid or the offer. Generally trading, looks like on the buy side on the 97. Unclear. There it is. 8,500 of them traded for 80 cents. And for the 8,500 contract trade, it was at 202. Yeah, so it looks like a buyer of that 97, 91 put spread. Maybe that shifts me a little bit here back towards the bear side. Could be a hedge to a long position. Still a lot of trading action to go today before the close. Earnings, implied volatility really only should drop down to about 60%, and implied volatility right now is like 68%. So it's a spot where a calendar actually does look very attractive for Robinhood. I'd be tempted by a double calendar. You know, August 22nd, 95 put is 305 versus 127, so it's about $1.75. And then the 115 calendar is $1.86 versus 442, 2.5. The call calendar is feeling a little bit, maybe a little too juicy, but you know, given the normal expected move of about 10%, that seems right on. I could go a little bit more out there and go to like a 120 and a 90. And given that this guy was doing the 97, 91 put spread today, we may be building up more downside in particular. So maybe it is better to go down to the 90 strike. I don't have to go through the strike or right to the strike in a calendar to profit. Yes, max profit is at the strike. But if I go through it, I was better off being on a lower strike that would be cheaper. So, you know, for example, the 90 put calendar to August 22nd is 190 versus 157, so 133. And the 95 is 130 versus 308, so 178. So it's about 20% cheaper to go for a little further out of the money. And if we do get the bigger move, like the 12 or 13 or 14% move, I still get a really nice return. If I only get 10% move, that's okay in a double calendar. Again, not really a slam dunk, but it does look pretty good. Implied volatility dropping 8% here would drop these by about 50 cents. So the 90 puts should decay by about 50 cents. And the August 1st 90 puts are 50 cents. So there's a little bit of neutrality there where I can think, okay, well, if we don't move, maybe implied volatility does fall even more. Maybe it doesn't go down 9%. Maybe it goes down 10 or 11%, and that's what makes that trade fail. But otherwise, if we find a floor at 60% or higher, oh, sorry, it's August 22nd. So yeah, 11%. So 65 cents. So I need a little bit of wiggle on the double calendar. If I go 120 and 90, I need a little wiggle. Probably $3, maybe 5. That seems like a high probability scenario. It's not going to be something where I'm going to quadruple my money, but it does a decent probability of success as long as we hit what we don't have one of those ridiculous 2% move days. All right. That's it for Hood. Let me think here. I'm going to kind of fast forward through some of the names here because I don't want to spend time on too many of the dead ones. Lamb Research I find interesting because of the tech side of things. It's a $100 stock. Normally moves about 6%, so we're looking at 94 and 106. The previous high is 102.5. 94 is right here, real close to that 50-day moving average, but real close also to this mini breakout level from June. The open interest is 95 and 105 instead of 94 and 106. So take that for what it's worth. The implied volatility is currently expected to drop down to all of 35%. So it goes back to that same sort of double calendar idea out to August 22nd. I go a little bit above the 105, below the 95, even though those look like more of a magnet strike. I think looking at like 107 and 93, getting a couple bucks away from it. Slightly bigger than normal move. The 107 calendar is 64 versus 160, so about 96 cents. And I expect the 107 call to drop by about 70 cents. So the 107 call being 65 cents puts me in a pretty good profit window there. Anywhere between about above, like say 103 and below 97, I feel pretty good about the double calendar. So 3% is kind of my minimum need for the double calendar. And we've had two that went below that. But it's a small loss if we only move 2-3%, and it's a potential for a decent sized gain if we move a little more, being in a double calendar. All right, so like 93 and 107 would be my strikes for a double calendar. Again, Qualcomm, nah. eBay, no. Let's do, I think AbbVie was one. Oh no, eBay was one that wasn't eBay one? Let me double check eBay. I think eBay was one that looked a little interesting. Yeah, so we've got a little bit of coin flip between whether we move 2% or we move 8%. Well, the reason I like this one was because up $6 is 8%. So the previous high is 8% higher. Below here is just under 8% to the downside now. Now that we've bounced off a little bit, but I was looking at this thinking 72.5 and 83.5 looked like pretty good windows. We don't have much open interest here except for at that 72 line. So we do have good open interest for the put side, not for the call side. Go out to August, not much open interest here on the call side. Go out to September, not much open interest here to target for the call side. So it's really just about the technical or the magnitude of the move, as well as the previous high and support levels. So again, just thinking about this in terms of where we've concentrated our money flow and looking at 72, looking at 83. Again, the previous high was 83.5. And the earnings implied volatility should fall down towards like 23%. So big impact on earnings, makes it not a calendar. It's a double fly in that scenario. For me, like a 74, 72, 70 It's about 20 cents. You know, an 81, 83, 85. It's about 15 cents. So 35-cent cash outlay to try to hit my window. Max value is $2. It's right in the right realm of leverage. I'm never going to get to $2 because I'm not going to call the pin all the way to Friday, more than likely. But if I can get to $1.40, I feel really good about that trade. Even $1, I feel really good about that trade. So eBay is somewhat interesting from the double fly perspective. And then we'll do Roblox just as it's just kind of an interesting one to look at. You know, they make so much money off their app. We do either 12% or we get up to 20%. And we've done 3 of these 20% kind of moves, and 1, 2, 3 of these 8% or 11% kind of moves. So what do we do? A 1 standard deviation move of 11% and move $15, $13 down to 110, up to 135, or do we do the big 20%er and have now, given current prices, a move to 100 or 145? And on the open interest, 100 is the biggest strike. That's the double, the 2 standard deviation move. On the call side, there's a lot at 125 and then at 140. So prior to today's move, 140 looked like a pretty good target, but now we're up $5 and starts to put into question the possibility of 145. I mean, one could kind of discount today's move and say, look, I can shoot for 140 and still look at 100 on the downside. It's a slightly tilted bearish bias, i.e. saying we could get closer to 20% to the downside, but we're more likely to stop around 15, 16% on the upside. With Roblox, I do look to go a little bit wider, $5 wide, 105, 195 put fly. That's about a quarter. And then 135, 140, 145 call fly, 355, 476 or $1.26. Yeah, about 30 cents. So it's, you know, 50 cents, 50 to 60 cents for a double fly that can max out at $5. So, I mean, that's where that leverage is really there. And my profit window in that scenario is anything between about a 10% move and a 20% move to the upside. And on the downside, it's between a 13% move and a 24% move, something like that, 23% move. That seems like a decent window to shoot for. And then lo and behold, of course, maybe we end up moving 5%, but that's the risk I take by having a good profit window with a nice range there that would normally be expected in Roblox's case. And if we have, you know, only $3 move, that's my losing scenario. But that's what I have to trade off when I've got the leverage and the potential upside of hitting my strike the right way. All right, that's the most interesting earnings I see. I'm going to skip the other ones for now. We'll take a look at Cleveland Cliffs since you mentioned it here, Fred. So ultimate support probably looking here around 10, just about that 200-day moving average, just about the July 11th high. This week's not going to be enough premium. Is next week enough? Next week's not bad, 14 cents. Or a 10.9.5 for a dime. So that's where the lever, like my ratio makes most sense to me is August 8th. 10.9.5 is 9-10 cents. That's the equivalent of 18 to 20 cents for a dollar wide put credit spread. That's about that's a decent credit for next week. The realized volatility has been 75%, but part of that's because they did have earnings here. So that earnings jump up. You know, I think that makes some sense. Looking at a put credit spread, effectively saying the earnings day low, which lines up really well with the July 11th high and the 200-day moving average and the 20-day moving average. All of these levels should create some support. So I like the thought. 10.9.5 or 10.9 put credit spread makes a lot of sense to me. And if we get down towards 9.5, that tells me I'm wrong. So if it's looking at the August 8th, 10.9 put credit spread for 13 cents, you know, my max risk could be closer to 50 cents if I let it go all the way to 9.5. That's the offset to it. But overall, it looks pretty solid. Or go an extra week, and now I've got 21 cents for the 10-9 put credit spread. Decent premium collection. Max loss is 29 cents if I stop out if it gets to 50. So overall, that looks like a pretty positive. That looks like a positive expected value trade to me. I think that makes some definite sense with the drift down here. Oh yes, STNG. So did they move 4%, and they're playing for the next leg higher. So a little bit more than the average move, a little bit more than the expected move, and now here we are. Oh gosh. 50 target would be my level. Applied volatility. And it was already low coming in. It doesn't have much more to fall. 47.5, 50 call spread, 90 cents. Defined risk. See if the momentum continues, and then just maybe it pins out at that September 50 line. I don't want to do it for August. 73 cents for August. I'd rather have an extra month for an extra 17 cents. So I think that would be my play here is the STNG September 47.5, 50 call debit spread. Needs the continuation, but now maybe getting onto people's radars. We are looking at that with TK as well. Their earnings are today after the close. So if STNG is now bullish, I don't know if there's a correlation on their earnings moves. Let's see. We'll just do the last three, red, red, green. No real correlation. Okay. So TK, no real correlation on the earnings. If they come in bullish, they could have a 5% or more move. The options here don't work. This is for the stock trader. I think after earnings, starting to look at a long stock and maybe even a buy right with it. But STNG has a little bit more liquidity in the options. There's just not huge opportunity in the option space for any of these tanker names, given their general lack of liquidity and, frankly, general lack of interest in the tanker names for a long time horizon. We'll see if that shifts in the coming days. All right, folks, it is 10:30. I'm going to let you guys go here, but generally looking okay today. Just a quick last look here. We got nice continued bounce back in Caterpillar, CSX as well, ES kind of unchanged here, slightly higher. Invesco now slightly higher, and NVIDIA now up $3. So, NVIDIA is the one that's got the most interest from the marketplace in all those. Caterpillar second, and then we'll see if CSX event driven maybe gets a big pump there. IVZ and ES, we'll see how that goes. So otherwise we will let you guys go there. Hope you have a wonderful trading day. Good luck with the Fed and some of the earnings starting up this afternoon with Meta and Microsoft. We'll see how it goes. Thanks again, guys. Have a great day.